Welcome to the Deep Dive. We're Talk Tickers, and our mission is simple. We distill those critical earnings calls, those investor updates, into the core knowledge you really need.
And today, we are navigating the complexities of the GKO Q3 2025 earnings call.
This was a really interesting one to get into. It's marked by these two sort of contradictory forces. On one hand, you have this intense, immediate financial discipline.
And on the other, an aggressive, almost unbelievable long-term strategic pivot toward AI and automation.
It really did feel like a tightrope walk.
Oh, absolutely. You've got GKO showing true financial grit, but then they're also laying out this vision for the future of R&D that is, fundamentally disruptive.
They're really shifting focus.
Yeah, they're moving away from being primarily a research services provider to, cementing their role as a core tools provider. It's biotech infrastructure, a massive shift.
Okay, so let's start with the financial reality they've built, because that level of austerity is what bought them the right to even have this ambitious strategy.
Exactly. The big story, the executive summary, it's all about that drastic financial tightening.
The number that just jumps off the page is the cash burn.
It's the number everyone needs to focus on. GKO slashed their quarterly cash burn by an incredible 75% year over year.
To 75%.
It dropped from $114 million down to just $28 million in Q3. That's the clearest possible evidence that the restructuring they did is working. The financial house is, in order.
And that discipline, crucially, protected their runway. They ended the quarter with $462 million in cash and cash equivalents.
And zero bank debt.
Right. So that's a significant war chest. It's exactly what they need, especially since management basically signaled that the cost takeout phase is more or less complete.
Yeah, 2025 was about cuts. Now they can focus on funding the growth investments they've got planned for 2026.
Okay, let's look at the top line, because the revenue data, it needs a bit of careful interpretation here.
It really does. So Cell Engineering revenue was $29 million for the quarter. At first glance, that looks like a 61% drop year over year.
Which sounds catastrophic.
It does. And this is where we have to apply that context to see the real underlying health of the business. The thing is, the prior year's quarter had this $45 million non-cash deferred revenue release.
That was from the Motif FoodWorks agreement termination, right? A one-time accounting gain.
Exactly. It was a benefit from a contract termination. Non-cash, non-recurring. So it completely distorts the comparison.
So if you strip that $45 million out of the prior year,
the adjusted revenue decline was a much more manageable 11%. So yeah, the business definitely felt the impact of restructuring, but the underlying erosion was, controlled.
Okay, and what about biosecurity?
That provided another $9 million in revenue, and it reported a strong 19% segment gross margin.
They also seem to have rationalized their programs a bit.
They did. They supported 102 revenue-generating cell engineering programs. That's a 5% decrease year over year, which management directly linked to, shedding lower margin or strategically non-aligned projects.
And despite all this internal shakeup, they reaffirmed their full-year guidance.
Right, sticking with the range of $167 to $187 million overall. The market really took that as a positive sign that management feels confident this whole shift will stabilize revenues pretty quickly.
Now let's dig a bit deeper into that cost management success, because those spending decreases were substantial. Where did the biggest savings actually come from?
Well, the efficiency drive was pretty broad, but the largest cuts really came from the administrative side. In cell engineering, R&D expense went down a notable 8%.
From $55 million to $51.
Right, but the real operational efficiency shines through in G&A, general and administrative expense. That just plummeted by 47%. From $23 million down to $12.
Okay, so those numbers reflect the full force of the restructuring. But we have to talk about the total operating loss, because if you just look at the headline number, it widened dramatically.
It did, which seems totally backwards, right?
Yeah. If you're cutting costs, how is the loss getting bigger?
This is maybe the most confusing financial part of the entire report, so we should slow down here. The cell engineering segment operating loss widened to $37 million this quarter. Last year, same period, it was only a $5 million loss.
So a $32 million difference, that looks alarming.
It does, until you isolate the two major non-comparable factors that are driving that number.
Okay, so walk us through those two factors again. How do they inflate this quarter's loss?
Okay, so first, in the prior year, you had the benefit of that $45 million non-cash Motif revenue we just talked about. If that hadn't existed, the prior year operating loss would have been way higher than $5 million.
Got it. So last year's number was artificially low. What about this year?
In this quarter, Q3 2025, GKO recorded a $21 million shortfall obligation. This was related to their Google Cloud contract, a one-time charge straight against operating income this quarter.
Okay, so they took a massive 21 million hit this quarter, and they lost a massive 45 million benefit from last year. The comparison is just wildly skewed.
Exactly. If you normalize for those things, the underlying operational health looks a lot better than that headline number suggests. It's the clearing of the books, not a failure of operations.
And speaking of clearing the books, that Google Cloud situation, the resolution there is another huge win for them.
A huge win. So they finalized this in October. That 21 million shortfall obligation, they ultimately settled it for 14 million.
So a 7 million cash savings. But the strategic advantages they got seem way more valuable than that.
They absolutely are. They managed to amend the whole contract, which cut their go-forward spending commitment by over $100 million.
$100 million.
And maybe most importantly for their long-term stability, they extended the contract term, doubled it from the original 3 years to 6.
So you're telling me they reduced a 9-figure commitment and doubled the contract term? That sounds incredibly favorable. Why would Google agree to that?
Well, the CEO explained it as just an adjustment to market reality. When they signed the original deal, the assumption was this rapid, broad adoption of bio-based AI.
So GKO expected to need a ton of computing power, fast.
Exactly, for huge, front-loaded internal training needs. But the industry adoption of this specialized bio-AI has been slower than, say, generalized reasoning models like GPT. So GKO adjusted its needs, and Google was willing to stretch the spend out over 6 years. It just aligns the consumption with GKO's new, kind of slower-paced trajectory.
Before we pivot fully to strategy, there's one more overhead detail we should mention. They are still paying for past growth.
They are. Management highlighted a $14 million carrying cost. It's related to excess lease space.
So just empty offices.
Basically, it's a non-revenue driving cash operating cost, a significant drag. The good news is management is actively trying to sublease that space. It's a headache from right-sizing the company, but it should fade over time.
So the foundation is set. They navigated the financial storm, cleared major contract obligations, slashed their cash burn, and secured a huge runway. Now for the ambition.
The strategic pivot to AI and automation tools. This is the core thesis of the GKO story from here on out.
Their mission is still to make biology easier to engineer.
Right. But the delivery mechanism is changing. They're pivoting heavily toward a tools business model, selling the infrastructure, the automation systems, the data, alongside their existing research solutions, which are now powered by those tools.
And they set out 3 critical objectives for 2026 to make this real. What are those goals?
Okay, first, they aim to deliver robotics and software for autonomous labs on-prem. So installing their RACK systems right at customer sites.
Yeah.
Second, they're expanding their own Boston Frontier autonomous lab to be a showpiece. They're targeting 100 RACKs there to demonstrate the art of the possible to, major biopharma clients.
And the third piece.
Third, they're going to leverage all that internal robotic infrastructure to offer CRO services that are truly best in class, purely because of that underlying automation advantage.
The linchpin for all of this is the RACK system, the Reconfigurable Automation Cart. Help us understand why this is so different from what labs use now.
This is the key insight for the entire investment thesis. Traditional automation in a lab, it's custom built for one single application. Think of it like a very specific assembly line designed only to produce one model of car.
So it's expensive, it's inflexible, and it probably becomes obsolete pretty fast.
Exactly. It gets decommissioned after a few years. The RACK is the opposite. It's standardized, productized hardware built like sophisticated Lego blocks.
Lego blocks, I like that.
It integrates all this diverse lab equipment into software-controlled setups that are general purpose. They can be expanded, reconfigured for totally different experiments. It creates a general-purpose autonomous lab. GKO is trying to be the Android for lab infrastructure, replacing that old world of custom hardware.
That's a huge claim. I mean, if they succeed, they basically standardize the infrastructure for scientific discovery.
That's the goal.
Yeah.
But the system only works if AI is driving it. And management identified two fundamental ways AI will impact biotech, and they're positioned for both.
What's the first bucket?
So the first one sounds like pure science fiction, reasoning models controlling labs. This is about connecting advanced language models like a GPT-5 or a Gemini directly to the physical RACK automation.
So the AI thinks, and the robot does.
Precisely. The model provides the logic, it writes the code to design multi-step experiments, and the RACKs are the physical hands in the lab executing those complex instructions, all without a human touching anything.
Wow. Okay, and the second bucket, biological language models. That sounds more like the data side of things.
It is. These are neural networks trained specifically on biological data DNA, amino acid sequences, so the system can speak biology and predict outcomes. GKO supports this with their data point service, releasing high-quality AI-ready data sets and even sponsoring competitions to accelerate development.
And this whole strategic shift, it's not just about their internal economics. It ties into this bigger macro trend, doesn't it? National security, global competition.
That's a critical piece of the context. Management pointed out that the historical U.S. biotech advantage, which was all about having highly trained human scientists, that advantage is eroding.
Because costs are lower and expertise is rising everywhere else.
Exactly. So the only way for the U.S. to maintain dominance in scientific discovery is through superior scaled robotic infrastructure and automation. And you see that echoed in government spending, like America's AI Action Plan or the NSF pushing for programmable cloud labs. GPO is positioning itself as the key supplier for that critical infrastructure.
And while the pivot is all about tools, their research solution side is still landing some big wins.
Oh yeah, they highlighted a $22 million BARDA award. That's the Biomedical Advanced Research and Development Authority. It's focused on manufacturing monoclonal antibodies here in the U.S.
The goal being to reduce the cost of biologics by automating their production.
Right. And they also extended their partnership with Bayer to engineer microbes for fertilizer production. That's a great example of the high-impact work they can do. It's a technical solution aimed at replacing the incredibly energy-intensive Haber-Bosch process.
Which is responsible for a huge chunk of global greenhouse gas emissions, so that shows the profound real-world utility of their platform.
And if you connect all this to their long-term vision, it's extremely aggressive. By 2030, they want their revenue mix to be 80% tools. So RACK systems, software, reagents versus just 20% services.
80/20. That's a monumental target. It's a complete transformation of their business in just 5 years. To get there, what's the immediate proof point they're looking for in 2026?
They gave very specific milestones. Internally, they want 50-plus scientists simultaneously ordering from their Boston automation system in a single day. That proves operational scale.
And externally?
Externally, the big one is a large biopharma company making a major purchase of a very large RACK system for a general-purpose autonomous lab. That would be the market signal that the tide is really turning.
So if we zoom out for you, the listener, the implication here is profound. If AI and robotics can eliminate the limits of human hands and reasoning in R&D, what happens to the cost of discovery?
Management suggests a fundamental shift. The dominant cost in R&D has always been human time, specialized expertise, expensive lab space. That could all shift to simply the cost of reagents and consumables.
That's an exponential increase in scientific productivity.
And potentially much cheaper discoveries. And the feedback on their approach seems positive. They have this try it before you buy it model where customers can test protocols on their big Boston setup before they commit to installing their own systems.
Which significantly de-risks the whole thing for a big pharma company.
It's just smart sales strategy. Why bet billions on a new platform when you can prove it works on GKO's setup first?
All right, that brings us to our This Is Not Financial Advice segment. Given the aggressive, high-risk, high-reward nature of this whole pivot, we need an outrageous but plausible trade idea based on that 2030 vision.
The thesis is pure infrastructure replacement. I mean, if GKO succeeds in selling RACKs to a critical mass of biopharma companies, if they hit that 2026 milestone and then just keep repeating it, the legacy automation market gets replaced.
By the general purpose lab.
Exactly.
Right.
So the trade is a highly leveraged, long-dated call option on GKO. You are betting purely on the successful execution of that 80-20 tools to services mix by 2030.
So you're betting that GKO becomes the standardized Android operating system for lab infrastructure. If that happens, their long-term growth potential just dwarfs any current revenue metrics.
It's a moonshot. It's a bet on technological dominance in a brand new category. If they execute, they own the infrastructure for the autonomous lab of the future.
So to sum up, the GKO Q3 call was a remarkable study in strategic redirection. They delivered profound financial discipline. That 75% cash burn reduction is the key, and that cleared the path for them to aggressively pivot.
A pivot to becoming the critical supplier of the AI-enabled infrastructure that will, redefine scientific discovery itself. The long-term shift toward automated science isn't hypothetical, it's a multi-billion-dollar build-out, and GKO has positioned itself right at the epicenter.
And we'll leave you with this provocative thought. If AI and robotics can eventually replace the craft of human experimental science, accelerating the speed of discovery by orders of magnitude, what complex scientific question do you wish you had the resources to pursue?
And remember, this discussion is purely an analysis of the public call and management commentary, and it is absolutely not investment advice.
Thanks for tuning into the deep dive. We'll catch you on the next exploration of the market's biggest calls.